In this video, traders, we're going to look at what does catching a falling knife mean. Stay tuned. Hey traders, warm welcome to you. All right, so catching a falling knife. Pretty apt at the moment with the conditions. That is really when you are, okay, obviously if you think about what that actually means, it's like, hey, the knife falling and you're there trying to catch it. You might get away with it and get the handle. If you get it wrong, your hand is sliced. And that's really the analogy for this, right? The market's falling lower, 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 lower. Catching a falling knife is you trying to guess where the bottom is. Okay, you'd never do that. If a knife was falling out of a kind of fourth floor window, you'd never catch it, right? If you wanted the knife, you'd wait for it to stop moving first and then pick it up. And that's kind of the analogy of the markets. Many people go, oh, this is way too low, I'm going to buy. And they kind of guess where the low is. And that's catching the falling knife, just guessing where the low is. Now, if you're right, great, perfect. But most of the time, you're not going to be. Just think how many new lows you've had in a trend before it eventually bounces. And so catching a falling knife is that trying to buy a low without structure. That's the key part. There's nothing wrong with trying to buy a low, but you have to have certain rules when you're getting involved in that. Now, obviously, when markets are extremes, that creates opportunity. So we're not saying we don't buy a market when it's down a lot, but we're very structured and careful about how we do it. So 3 ways that you might do it. So this one is the kind of catching the falling knife, i.e. there's no structure to it. It's down a lot, I'm buying it. That's not going to work over time. You might get away with it a few times, but that's not a repeatable process. Let's look at another one. Number 2, this is where you are using some kind of structured pattern to buy the low. And this would be, hey, like a double bottom, for example, or a fresh low that comes back up. This is a real classic one, guys. It comes down, goes back through the low, comes back up. You're trading it as it comes back up through the low. Your stop's there. It's very simple, it's very clean, it's very easy. Now, is that definitely going to be low? You never know. But at least you've got a level that you've seen some buyers, right? Some buyers have come in again, some buyers have come in there. You've got an obvious place for your stop, obvious place to get in. It's a little bit more of a structured trade. Here, the trap that a lot of people fall into is they buy, it goes a little bit lower, they hold it, or maybe they add, and there's no structure, and then it just goes lower and lower and lower, and eventually the reason they come out is because they can't take the pain anymore. You don't want to be that situation. You want to be the other side of the situation, spotting that. Which does bring me very nicely to number 3, which is imagine this is where that was there and it goes lower and lower and lower. Now this is something that requires timing and you have to be very, very strict with your risk management here. But this is buying an exhaustion move. An exhaustion move is a very, very quick move in terms of number of ticks, number of pips, a short period of time accompanied by volume. So you've kind of got this lower, 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 then a big move lower, a big hike in volume. So that tends to, and if it's the end of a trend, you could say that's exhaustion. Sometimes it's very hard to spot, sometimes don't get it, but that could be a thing you're looking for to catch the low. Now, is that catching a falling knife? No, because you've got something you're looking for specifically. And you might want to quantify that and say, hey, I want to see 100 points on the Dow within 1 minute, and I want to see volume, highest volume bar of the day, or whatever it may be, right? Whatever market you're trading. And you'd say, if we do that, I'll buy it. I'll use a 50-point stop. Again, you've got to be very, very tight with your stops and very strict. I'll buy it, and my thesis is that's the last of the sellers just selling everything they've got out of the trade. They can't take it anymore, and done. And so that's another structured way to do it. This isn't that you're not always going to get this. Looks like you're not always going to get this, but it's better than just diving in and just buying blindly because it's down a lot. It's dangerous. This can be dangerous, but if you use a good trigger for it, and you use a very, very sensible stop and just have a wide stop, then these can work. These exhaustion moves can work and they can be very lucrative. The other one could be like a little bit later in the turn. So you go, right, this market can go as low as it wants. I'm not interested. But when it starts to creep back up, then I'll buy it because I believe that maybe we're going to come back up to a volume weighted average price here, or whatever it may be, back to the 50% of the move, whatever your retracement target is. And so this time you wait for more of a confirmation trade. So the downside of this is it's a little bit later in the move, but again, what you're doing is psychologically you're saying, hey, I'm not going to just buy anything. I only want to see a low put in 1, a low put in 2, and then it take out that high. So in this example here, where we bought here, you'd actually be buying here. So when it came up and breached that high, that would be your buy. So it's a little bit more confirmation. A few more buyers have stepped in that portion, giving you a little bit potentially more weight to the trade. And obviously, you've got to structure the stop around it, all this type of stuff. There's downsides to that. It's not a nirvana or panacea, should I say. It's not the kind of be all and end all, but it's far better, in my opinion, than just kind of guessing where that low is and having a stab at it, because that is catching a falling knife. Here you're waiting for at least some buyers to come in and then just some second buying to kind of prove there's something there. Here you're waiting for an extreme kind of bunch of selling and the assumption is that's not going to be sustainable. And here you're waiting to see a bottom put in, another second bottom put in, or whatever it kind of looks like, but then a break above the high. So some kind of strength within the broad weakness. So the 3 examples of how you could trade that low, but not just diving in just because, oh, it's down 500 points, down 1,000, it can't go any lower. I've seen it go way, way lower. You don't want to be that guy, because you're the guy there who's coming out when the calm trader is waiting for everyone who bought too low, too low, too low. Oh my God, I can't say anymore. What's happening? Something's going on. There must be some news. Out goes the position. Patient traders are buying, pops back up, and maybe it's a full reversal, maybe it's just a nice trade. Who knows? But the difference in catching a falling knife versus a structured reversal trade. Take care, keep your risk managed. I will see you in the next one. Thanks guys, bye bye.